All right, good afternoon, everybody. My name is Doc Severson. I'm with ReadySetTrade. Today's 3 o'clock coaching session here is for the 10X Tribe and plus anybody that happens to be on our YouTube channel as well. And of course, I can't forget those on our elite service. Welcome aboard, everybody. We'll have a little bit of fun here today. Start queuing up your questions. If there's anything about the market, about the options market, anything to do with anything, go ahead and throw your question in. Just add it to the chat window, and we will get to that. So what I'm going to do in the meantime, while you guys are firing questions in, is I'm going to go to, going to hide down in the lower left-hand corner here, and got a couple of slides to go through with you guys. So one of the questions that we've been talking about quite a bit lately is hedging a portfolio. Now, what is this and what's involved with doing something like this? We've had a lot of interest from people thinking that the market's going to basically crash any day now from this historic massive rally off the March lows, right? I believe in the phrase that I once heard, it's better to play defense during times of peace than not times of war, right? So what that means is that the actions that you need to take to protect your portfolio should be done when things are quiet, when markets are heading higher, and not when things are tumbling down, when everybody else is doing the same thing. It is usually too expensive, and your efforts are not going to be very successful if you're trying to hedge a position and chase it down the rabbit hole. To some degree, this can be a contrarian sign that the market's about to embark on their final climb the wall of worry leg. Now, what I mean by this is that if a lot of people are saying, hey, I'm really negative on the market, I really want to learn about hedging. A lot of times what this can mean is that we're just about ready to go on that final leg to the upside. A good example of this is if you were to go back in 2017. Now, 2016 was really choppy. After the election, there came some certainty back into the market. Hello, Willis. Good to see you guys. Welcome aboard, everybody. If you want to let us know where you're coming in from, that's cool. Also, if you have any questions that you want me to go over after this short death by PowerPoint presentation, let me know what that is and I'll get to your topic. So in 2017, we started to grind to the upside like this, and it was just an all-year rally without really any pause to it at all. And so we got into 2018. We ticked over the calendar, and everybody's like, well, wait till you see what happens next. Everybody was predicting a crash, and what did we get instead? We got one incredible rally leg to the upside. Go check it out on your chart. Go look at 2017 and then the first month of 2018, and you'll see exactly what I'm talking about. So that's kind of what I'm waiting for. Is a lot of people are bearish right now. A lot of people are very skeptical of the market. And I'm wondering if we have one last leg in us, and that could be just enough time for us to put some hedging into place for this. So I'm going to go over 9 points here. Hello from Pretoria, South Africa. Great to have you here. Hope you're having a good evening out there. Must be pretty late by this time. Number one is that you'll never be able to time the top. And when I say time the top, I mean time the top. You will not be able to find that actual final tick. Nobody ever rings the bell when it's the final tick of the market. If you guys go back a year, did anybody really ring the bell? When we finished out with the rally from 2019 into early 2020, it just kept grinding higher. And this is what is called an exogenous event, if you want a cool name to call this thing. Markets are very efficient. They price in all known information to the second. And then what happened was this thing came in called this COVID-19 virus, which was unanticipated. And the market started to sell off. But it didn't really get bad until we had certain members of the financial media basically saying, you know what? We're going to have to shut down the economy for at least a month. And everybody was not prepared for that. That's when we got our really bad stuff. So there was nothing really to tell you. You can't play the look in the rearview mirror game and say, well, everybody should have known that. And quite honestly, if anybody is out there saying that we made the call that said it was the top of the market, guys, that's bullshit. That's bullshit, because every other day they were saying, yeah, we think it's going to go down, but it could go further up. So you can always manufacture some kind of excuse like that. But I'm here to tell you that the very most difficult technical signal that you're ever going to find is the top of the market. They're all different. They never feel the same. One thing is universally seen, though, in a market top is that you'll feel like an absolute idiot applying any type of hedging at that point. That's usually a good sign if you think, well, man, this is a waste of money. There's no reason for me to put this on. The market's just kind of grinding higher. I don't see any reason to put any kind of protection on. That's actually the best time to do it. When volatility's low, when nobody expects it, that is the best time to do it. Hey guys, if you have any questions that you want me to address at the end of this little presentation, we'll probably go 30, 45 minutes here. It depends on how many questions come in. I've got a short topic here on hedging, and then once I finish that, it'll be open floor. So what I want to warn you is that you're never going to be able to time the top. Hey, Marcos, good to see you. So with that in mind, let's get to some of the mechanics here. Number 2 is the simple and effective thing to do. And this is mostly what we were doing last year. So last year at this time, the conditions were not very good for this type of trade. So I couldn't sell any puts. I was basically doing call spreads, but they were super expensive because of the volatility skew between the puts and the calls. So it was an option buyer's market. And that's not necessarily a bad thing. So this is what's going to happen when we get into that final push. It becomes an option buyer's market, not an option seller's market. And the thing about buying options is that it will limit your risk to what you paid for that position. So yeah, if we drop down like this, okay, so you can wave goodbye at what you paid for the position. But this is always where we're going to be limiting our risk to no more than 2% per position. So yeah, it's not convenient, but it doesn't really hurt. So if you do this right, you're selling into the final move, wherever the top is. You don't know where the top is, and I guarantee you, when you sell into the position and the top keeps on going a little bit, this will drive you nuts. But it's just part of the game. And it's up to you to have the discipline not to chase back up after it. Hey, thanks for checking in from Lithuania. Good to see you. Here's the second thing that you can do. So same as number 2, but liquidate your longs into cash and then use a small portion of them to buy 3 to 6 month calls on the S&P. These are not going to be necessarily cheap, but it's not going to be, especially if the market's heading higher, the implied volatility will be relatively low. These won't be that expensive. Sell them into strength as well. If the market pukes, your loss is limited. So what I'm talking about here is that you're selling into, let's go with a different color. You're selling into that final screaming move higher, and maybe you get out right there. Or maybe it's a combination of selling right there. And maybe the market will go just a little bit longer than that. Maybe it'll coast on some momentum before you start to see it really breaking down. Buy some calls here and then sell those into strength as well too. Maybe have a target of taking them off at 100% or whatever feels comfortable to you. But the worst comes to worst, what's going to happen is if it just flames out like here and then drives down, the most you're going to lose is what you paid for those calls. Each call option is going to represent the gains and losses of 100 shares of stock. But once the expiration date hits, you're not on the hook for anything. So it's a cool way. It's a very simple way to do something like this. Hello, if you're just joining us here. Again, my name is Doc Severson with ReadySetTrade. We're just running a quick little coaching session today. One of the things that everybody seems to want to talk about lately is hedging. So we're just going to go through a quick 9-point presentation on that and then take your questions at the end of it. Number 4, classic tail risk. So if you've ever heard of the statistics of tail risk really means this whole, mean distribution curve that's out there. And we have one standard deviation, plus and minus, and 68% of the opportunities are going to fall within the meat of the bell curve here. And then we have moves out here to 2 standard deviations. We're aware of those. But the tail risk is what happens when you get out to like areas like, way out here, right? Way out here or way down here. This is called tail risk. And it's, several standard deviations of price movement. And we certainly had some tail risk that came in last year at this time. Near the end of February, certainly into March, we had massive amounts of tail risk. So classic tail risk insurance is to buy out of the money put options with 3 to 6 months of time. So let's go ahead and do that. Not going to buy these, but I'm just going to bring up the chart and take a look at these and see what would it cost. So if we go out to, say, like the S&P 500 spiders, that'd be a good way to do this. And if we go out to maybe 3 months, so we're talking about March, April, May. So we'll look at May options. And why don't we do something like 10% out of the money? So if the current price is, say, $3.93, 10% out of the money would be about a $3.54 strike price. Well, let's see how much that is. $3.54 is going to be about $700 per contract. That's your tail risk. That's the insurance of your tail risk. Now, if this actually were to get at the money, you'd see the price be roughly, this is a real rough approximation, but because the implied volatility would be screaming higher at this point, but they would be worth, say, at least $1,500. So they'd be worth at least a double for that, but more than likely a lot more than that if the applied volatility were to jump higher. So you can kind of experiment with an analyzer and see what kind of changes that we would have. You can look back at the VIX and see what kind of a move that we would have and estimate what it would be worth to your portfolio. But that's kind of a sledgehammer approach, because what you'll find is, like, if you're going to do this every couple of months and have this trailing tail risk on, you're going to find that it's pretty expensive. And so this is the main thing behind something like this. You're holding this insurance is a wasting asset. It will decay on you. It's not something you're going to look at it every day and it's going to go more and more red and you're going to go, why am I doing this? And then right at the top, right when you say, you know what, I'm not going to do it again this next cycle, because this just feels like throwing money out the door. That's exactly when the move will come. So that's just to give you an idea of what would happen, something like that, to buy this tail risk insurance. Number 5, one way to protect against some limited downside is to set up what are called costless collars. Now, a collar can be a couple of different ways. What you're going to do is you're going to buy that long put for the insurance. So if we have the price here, let's say the price is here moving around, what we're going to do is we're going to sell a call option up here. So we'll just say a C- call option up here. We're going to sell that, and you want the price to stay below that call option so you don't have to surrender your stock. And below that, we're going to have, way out of the money, a put option, and we'll put plus over here because we want to designate that that's a long put option. So this brings in money when we sell that. This one costs money when we buy that. So if we do this right, we can basically, based on what we collect for the call over a period of time. So more than likely you would want to be doing these, you'd want to be writing these calls on a short-term basis so you don't have too much time exposure for these, and then have your long put be sort of longer than that. Now, the other version of this is just to use a long put spread at the money, which is a fixed profit for that. So it's not going to give you unlimited downside protection, just a certain amount of protection, but it's a much easier to play. You're not going to have the time decay happening with a long put spread like this. This will last almost until expiration without significant decay if you do it right, and then finance that through a short call option as well too. This will be much cheaper to do, but the downside protection of this is very limited. Okay, if you have any questions on this, please reach out to me offline, doc@ReadySet.trade. Be happy to answer your questions. Number 6, you can also do what's called beta weighting your portfolio. We talked about beta weighting in our coaching session with the elite class last Thursday. So we went through a whole example of beta weighting and how to do this. So it's a more, I'd say, more complicated version of hedging a portfolio, but it allows you to really dial in. It's like flying with a full complement of instruments, because you can really see how each factor addresses the risk and will influence the risk. So you may have heard of this before, but it's something where you're normalizing the value of your portfolio to the S&P 500 and then using tools to be able to address the risk to the downside from that point. Hello, folks. If you're just joining us here, welcome aboard. My name's Doc Severson with ReadySetTrade. Thanks for coming by today, talking about a little bit of hedging. If you're just bumping into us, you can always rewind this later, and that's the nice thing about these YouTube videos is you can always just dial back and watch it later. Plus, I'll take your questions once I finish up here. Number 7, you can use various VIX or volatility products to help hedge our downside. This also sounds far easier than it is. A lot of people say, well, why don't you just buy the VIX? Well, the VIX is based on VIX futures. VIX options are based on VIX futures, which can be priced anywhere that they want to be because they're based on somebody's efficient market mechanism. So sometimes they don't always make sense. The term structure can get kind of screwed up. Once again, you already have to be in the product before the move happens. You have to anticipate the move, and you might find that the VIX futures have already anticipated the move before you can even think about it. This is very common. So a lot of times it depends on which option that you get, how far out, and what strike price, things like that. So it's certainly a lot more complicated. This is why I'm saying it sounds easier than it really is to do. So as you'll notice, as I go further up in numbers here, we're getting more and more complicated with things. So another technique is called Vega hedging. Vega is the sensitivity to implied volatility changes. And if we have a move to the downside, you can bet that we're going to have a massive spike in implied volatility. What you can do is, once again, before, you guys like the sweatshirt game set match? I like this one. Just got it today. GME set match. You can take that a couple of different ways. So Vega hedging involves setting up various inexpensive out-of-the-money trades. So let's I'm going to draw the price in a horizontal manner. So the price is, maybe trading up around here. And if it dives, it's going to head in this direction. So I'm just setting up price as the x-axis here. What you can do is, while the price is up here and things are quiet, you can set up things like calendar spreads, which if you put them in the right place, if you locate them in the right place, put them in the right position, do everything right with these, will grow almost exponentially of implied volatility. So we'll start out with something like this, which costs a certain amount, and then next thing you know, it grows like a monster. It's like, one of those Japanese movies. So this is Vega hedging and using the right positions for something like this. Now, long put options will do the same thing as well too. It's just that you're paying a fortune for them. These, if you set them up right, you'll pay not very much and they will grow almost exponentially. And then finally, number 9, with so many traders or institutions already buying insurance, protection is expensive right now. And there's a reason why we've had the VIX above 20 for the past year. It's, I think, the second longest time that it's been above 20 for this long. So protection is expensive. There's ways to help finance the insurance positions to reduce the drag or cost at some loss in efficiency. So this is really a combination of where you're buying and selling options. You're trying to be strategic about how you're doing it to be able to get insurance for a little bit less. So you're going to be able to find it kind of the same concept that we talked about with the collar, where you're buying protection, but you're financing it in a creative way. The most important thing that you can do with hedging and portfolio protection is to be proactive. Be proactive. What does that mean? That means you have to learn first about this. You got time. You have to learn about the measures to put into play, taking care that they don't add more risk than the native portfolio does. If you don't know what you're doing, you'll add more risk than what you're trying to protect against. There's all kinds of risk out there. There's time risk. There's volatility risk, gamma risk. And then you have to learn to add them as insurance to your portfolio, a little at a time. A little dab will do you, as they used to say. Use them precisely when it feels ridiculous to do so. If you feel like a big dumb jerk for putting on your insurance, chances are it might be the good time to do that. Might be a correct time. Okay. So we'll be adding this course to the ReadySetTrade course library soon. Elite members will have access to it first. Elite members will have access to it first. Okay, so I will take your questions at this time. And while you guys are typing those in, I want to encourage you guys. Sometimes I get into trouble for saying that because there's plenty of ladies that tune in as well too. It's more of it's just more of a common term, right? Hey, you guys. Or now that I live in the South, I have to learn how to say y'all. But if you sign up for ReadySetTrade, you can join us for free. And you can get into the 10X Trader Tribe. And you can get into, if you just go to elite.readyset.trade right now, you can see what's available to you. And then if you decide you want to, go ahead and join us for free. We're not going to spam you, anything like that. For those that want to take it to the next step, though, we have the elite in the trader tribes. That's our subscription service. That's where we post trades, and we do live sessions 5 times a week in the mornings. Okay, what questions do you guys have? Anything is fair game. While you're doing that, let's take a look at the market. Let's see what's happening today. Here's the S&P, the spiders. We're, just a little bit of an interesting day. This was a challenge for us to do the zero DTEs because zero DTE trading is where we look to trade an option which is expiring today. And we wait until about 10:15, and it was out of the opening range at that point. So we say, nope, not going to do it. And actually, this probably saved us quite a bit of aggravation for not doing that. Donatas in Lithuania. I'm currently trading Forex, but started to take an interest in options. Would you advise to trade equity or crypto for starters. I don't think there's no comparison right now with the options market between crypto and the equity markets. The equity markets are many orders of magnitude deeper, more liquid in the United States. Now, that's the United States. Now, it depends on if you can get access to the United States. So it's the opposite situation in crypto, because crypto, our own government in the United States really prevents us from doing a lot of crypto trading. There's a lot of interfaces that we are not allowed to log into. And really, it's more about the provider not allowing us access to them. But with the United States, it's like the deepest, most liquid markets in the world. And if you can get an interface to allow you to trade them, I would do that first. Now, crypto spot is great. Crypto spot is wonderful because you can trade it 24/7, or the crypto futures, you can trade them 24/7. They never shut off. And they're getting to be much, much more liquid, especially if you're just trading BTC. But if you want to talk about options, there's no question, there's no comparison yet. I hope it changes. I hope crypto really grows up and really embraces options, because any institution that's investing their money into any financial market will always insist on having options for risk control. Okay. Marcos is asking, how do you train your mind to let go of a position when it's strong? Specifically, if the rally continues, for example, the one who sold BTC at 20. Okay, so what Marcos is asking is, how do you handle the situation? And let's, I'm going to bring back that example that I was talking about before of here's 2016, and here's the end into 2018. I would say the best way to handle that is to be mechanical, Marcos, is what do I always say about determining your exits? Do those before you enter a position, and then you're just playing your strategy, right? Determine your exits before you enter the position. And it will help you be mechanical about things. Now, some of the ways that you can do something like this, there's a couple of ways that you can, I would say number one, and I use this in futures all the time, is to scale out. I'm going to use my magic pen here, see if I can do this instead. And then number two is trailing stops. And if you don't know trailing stops, what you can do is use something like the parabolic SAR, which is the parabolic stop and reverse tool. So scaling out means that you'll start out, let's say you start out with 3 contracts down here. And what you're going to do is you're going to look for maybe 100% return on the first one, or whatever, however you want to do this. So at this point, you're going to sell into this one. You're going to have 2 left. And then maybe what you're going to do is you're going to sell the next one up here, and you're going to have 1 left. And then you're going to trail that based on a trailing stop as far as you possibly can. And the further up it goes, the further that you're going to trail that stop. So this allows you to stay into a position for longer because you have already booked a profit. And so scaling out and then maybe using trailing stops as well too is the only way I know of to do that. Because what you never want to do, never want to do is let a winner become a loser. And I know plenty of people that have done this. They're holding and holding and holding and holding, and they don't know when to sell. And this is what we found out from everybody back in the crypto bear that became in 2018 was that everybody's like, yeah, I'm just going to hodl. I'm a hodling guy, man. Hodl was the big word of the year back then. And it was cool to just say, oh, I'm hodling. Or in Wall Street bets these days, oh, I have diamond hands. I have diamond hands. I'm a strong holder. Okay, well, that's great. But what happened in Wall Street bets the last couple of weeks? Everybody said, oh, shit, I'm losing money. I'm going to sell because I have to take care of number one. So people that go into something and say, well, this is who I am and this is what I do because it sounds cool, all of a sudden, the game changes on you, doesn't it? And having that rock solid understanding, you know, what you find, Marcos, is like the less you care about a position, the better that is that you'll do with it. That should be your goal, is to just not care about how you manage a position. If it's so small that it doesn't even paint on your risk radar, then you'll probably manage it in the correct manner. The minute that you care about a position, the minute that you start to become protective about a position, like, oh shit, this is really dropping like a stone here, that's when you start making mistakes. That's when it becomes a lot more difficult. Okay, anybody have anything else? Any other questions for me? We intend to do this once a week for you guys on Tuesday afternoons. If there's a better time, let us know. We'll consider that. But we want to do one session in the afternoons, and we do Ready Set Crypto tomorrow afternoon. We'll do this tomorrow afternoon at Ready Set Crypto. So we'll probably do the same thing there. And then we've got coaching for the elite folks, which is on Thursday night. Again, any of these you can watch on a replay if you can't make it. But I invite you, if you know that we're going to be doing these, if you want to just post a question for us ahead of time, I'd be happy to do that if you can't watch it. All right, folks, that is, I think we're dry. I think we're good for now. Hope you guys got something out of this, and I look forward to seeing you next week. And again, let me know what you want to talk about so I can make it relevant to you. Thanks, everybody. You guys have a great Tuesday. We will see you soon, and take care. All right. You guys will have a good one, and see you tomorrow morning for some of you. Take care.